Hello and welcome to Prime Book. And today, what we're going to be discussing is exchange traded funds or ETFs. They're no longer just a niche investment idea, they are a global phenomena. Worldwide, ETF assets have just touched around $22 trillion now. And back home, India, what are investors doing there? They are catching up with that pace of ETF as well. We're still behind the global levels, but that is something that is low cost, transparent to build long term wealth as well. So, what is the opportunity here that lies for investors? What exactly is there behind this global shift to ETFs now, and even Indian investors looking at it? How is technology, AI, digital platforms changing the way investors think and discover these funds, pick these funds as well? We're going to be discussing all of this, and to break this down for us, what it means and how investors are looking at it, we have Devarsh Vakil, who is the head of Prime Research at HDFC Securities right now. Devarsh, thank you so much for joining us. On the show. It's a pleasure having you here as well.
Thank you for having me.
Devash, it's a very interesting topic, right? But before we dive into, the nitty-gritties of ETF, let's understand ETFs, exchange traded funds, as a concept for our viewers and investors, maybe who are not looking at it too closely.
Right. So ETF is a fascinating concept.
Yeah.
ETF is a combination of mutual fund and stocks. So it has got best features from both of them. So ETF is a basket of securities like a mutual fund, but it has also got live prices like a stock. So just like a mutual fund, you have a scheme of stocks or a list of stocks where ETF invests. For example, say we have a Nifty ETF. Nifty ETF invests in Nifty 50 stocks. But unlike mutual fund, where you have a NAV at the end of the day, ETF gives you live prices. So it is traded on the exchange. That's why hence the name exchange traded fund. It gives you live prices, so you can also invest during the day.
This is if someone wants to understand the difference between mutual fund as well as ETF, you did explain a little bit. You get NAVs. Mutual funds, you cannot do that on a day-to-day basis. Is that the major difference here versus ETF and a mutual fund? How would you differentiate?
Right. So there are two main differences. As we pointed out, the in mutual funds you can invest at the end of the day according to the NAV. Here in ETF, you get live prices during the market hours. So any point of time during the markets, you can invest. And the major difference is that in a mutual fund, there is a mutual fund manager who chooses the stocks. So those stocks may outperform or underperform the market. But when you are looking for a average market returns, here ETF, according to the index they are following, you are basically buying the market. So there is no question of underperforming or outperforming. Whatever the index grows, you will get those returns, barring small tracking error.
It's tracking the benchmark, right?
Yeah.
Of whatever they are looking to invest in. So
Correct.
whether it's a Nifty 50, like you were mentioning, or mid cap, small cap. So depending on that, it's going to track what that index is doing.
Correct. Now, why it is important?
Yeah.
For example, say you invest in a mutual fund and that mutual fund underperforms for 2 years, 3 years, 4 years, then your goal by investing in that mutual fund is not fulfilled. But when you are sure that a country is going to grow or the underlying scripts, the top 50 companies in case of Nifty 50 is going to grow, and when you want to bet for long term, these are a standard ETF instruments across the globe, which has become so popular, where you are taking away the risk of underperforming. You are taking the risk of selecting either the individual stock or a mutual fund manager away from this. You are nullifying that risk. And that's why ETFs have become very popular globally.
So because nullifying the risk, that is the reason why investors are looking at it as well in a better way.
Correct.
Since you said globally as well, and globally ETFs are doing so much better. Could you talk to us more in terms of the history of global ETFs as well, how they shaped up? Because today, that's become global ETF AUM is around $22 trillion, right now. How is that shaped up so well? And what is it so exciting apart from the risk going off as well?
Right. So, um, index was invented by Charles Dow in, say, 130, 140 years back. But it took many years for a concept like ETF to come into being. ETFs are around 30 to 40 years old in global markets. Those markets have seen phases where For years, the mutual funds or the active fund managers have not been able to beat the indices. And that's why the ETFs have been picking up. Here, see, ETFs have a risk of markets. If markets go down, obviously ETFs underlying index goes down, ETF may go down. But eventually, we have seen that if the country is growing, if the profits of those companies which are there in the index keeps on growing, the index come back, and index have given return, substantial return across in global market as well as in the Indian market. That's why ETFs have become very popular in US, in other parts of the world. Um, you will be surprised to know that the most traded instrument on American exchanges is not a stocks like Tesla or SpaceX. It is actually the ETF, Spider SPDR. It is the largest ETF in US, which has assets over under management of more than $2 trillion, and it is the most actively traded instrument in American markets. So yes, it has become very popular. A lot of pension funds, the regular investors, retail investors, they do their long-term savings using the ETFs, and that's why it has become very famous.
How has the growth been? If you can help us understand that also in the US specifically, if, the index that you were mentioning was one of the highest traded, what has the growth been over the years?
So growth has been phenomenal. The last few years,
Yeah.
the passive investments or the ETFs
Yeah.
have actually overtaken the active investments in US, and it has become a multi-trillion dollar industry. If my memory serves me right, it has become more than $20 trillion industry in US, and many parts of the globally also ETFs are catching up, including India.
Okay, we are catching up, right? So we are lagging a bit. What the global story or the US story played out. Is India in the same place right now? How is India's ETF story moving now? What have you seen over the years?
Right. So globally, ETF started around 1993 or so,
Hmm.
and it has been 33 years journey where they have become a very active part of a global investors portfolio. In India, we started around 2003 or so, and it has been around 25 years of journey, where earlier it was a niche product where only institutional investors used to invest, and then the regulatory changes happened. Government of India made a very significant change where they allowed employee provident fund to put in their capital into ETFs. So they started with 5% of the corpus, and now about 15% of the corpus from the EPFO goes into the ETFs. And that's why we have seen that there is an explosion in the demand for the ETFs. In fact, just like US, you will be surprised to know that let me ask you,
Yeah.
do you know what is the largest AUM scheme in India, mutual fund scheme? I'll tell you.
I was
It
assuming
is
now
the
you're going to say ETF.
Yes, the SBI ETF is
Okay.
the largest scheme in India. SBI Nifty ETF, more than 2 lakh crore. SBI Sensex ETF, more than 1 lakh crore. So these are the schemes which are catching up now. India is catching up, and large amount of money is being invested, and it is giving fantastic returns to their investors, fulfilling the need for return with relative safety.
Okay, so we are growing, we are catching pace. We can see that in those Amphi numbers that come in every month as well, that ETFs is something that is interesting investors. Maybe it may be different kinds of ETFs that are available. There are a lot of options available, right? Whether from commodities, whether from index traded funds. Then from here on, is there anything stopping India to maybe reach the level that how US is today? Is there anything that is maybe not doing well for India right now in this space? Or do we have everything in place to see the same growth for ETFs?
So India is relatively a younger country, younger economy, and we are not the level at which the US or other large economies have reached on the per capita basis. So the opportunity for mutual fund managers to outperform finding niche companies is still there, and that's why active investing is popular in India, and there is a room for active investments, active schemes to grow. But there is also a case for getting the standard return, getting the benchmark return, where you want to put your retirement corpus, where you want to invest for a goal. ETFs play a role. And I think that portion of ETFs, goal-based investing or some niche ideas, it is growing up and catching up in India also.
Okay, growing up, catching up in India as well. What is the opportunity? Maybe this is more, right? Given the global ETF size that we see, right? What is the opportunity for Indian investors to maybe diversify internationally also, or are we still stuck to investing in Indian ETFs? Is there an option for investors over there as well?
Yes, ETF do offer a lot of options.
Yeah.
For example, as you mentioned, we have our benchmark indices based ETFs like a Nifty ETF or a small cap ETF, mid cap ETF. Similarly, we have commodity ETFs, bond market or a debt market ETF. If somebody wants to diversify globally, we have global ETFs also. US based indices ETFs are available. Other Asian markets like Hong Kong ETFs is available, and you can diversify your portfolio globally also. So it depends upon the individual if he wants to do diversify according to his asset allocation,
Needs.
according to his needs. He can put certain amount of money into either commodity ETF, bond ETF, or even diversify globally by investing in global ETFs.
You know, Devarsh, today we have so much available on the internet as well, right? Plus, you have the help that comes in from digital, AI. So many platforms are there for you. How are you seeing that digitization coming in for investors, especially to maybe even look at ETFs or maybe the availability of options for ETFs? How should one be deciding so much with the availability of data that we have?
So digitization certainly helps. With the help of AI, earlier you need to know the name of the product in order to invest in it. Now you can go and ask any AI tool that this is what I would like to do. I would like to invest in, say, a mid cap ETF. Give me options, and AI will give you all the options. So the discovery part, where you are not actually aware about the products which are available, but you have some specific need or some general need, you can ask AI and get the discovery right. You do not have to depend on any individual. The second portion where technology plays a role is also the comparison. See, earlier you have to go to a distributor or internet and look for data across many ETFs and try to identify which one is outperforming or which one is a low cost, where is the liquidity more, what kind of AUM is there. But now with a simple prompt on AI tools, you can actually compare and come to a very good decision whether which one is better for you. And finally, the technology plays a role in the execution now. See, with the help of these digital tools, you can put in an order, a limit order in an ETF. So, say, for example, say currently the ETF is, say Nifty is trading at 25,000.
Yeah.
Usually the ETFs are 1/100th of the exchange value. So it is trading at, say, around 250 rupees. Now, if you think that no, it is a little high, I want to put an order at, say, 249. Here you can put an order with the help of digital apps at 249 and forget about it. Whenever market comes down to that level, your investment will be automatically done. So execution, also technology plays a very important role, which was not there earlier.
So technology, that's why has played a big role, and now from here on, that growth will also come because everybody today has everything on their phones, whether there are apps,
Correct.
and it's easier to maybe look at buying ETFs also versus previous times. So that's played a very big role. Is there anything that specifically you would help a investor who's first time looking at investing in ETFs, retail investors starting off? How would you suggest them to maybe look at this overall category? What is it that you would say that this is something you should watch out for? This is something you should avoid, maybe when you're starting off. How should they go about it?
Right. So um, I think what investors can do, they can start with goal-based investing. For example, say Indian indices have given historically about, say, 14 to 15% returns over a long period of time. Assuming that we will get that kind of returns, assume that, let's say, a little bit lower, say 12% kind of returns are going to come there. Now, if you have some need, for example, say I'm a new investor and I want to buy a car for 10 years down the line, say 10 lakh rupees a car 10 years down the line. That's my goal. Now, using the technology, I can actually find out that, okay, if I want to save 10 lakh rupees 10 years down the line, assuming 12% XIR, well, how much money should I invest? And the AI tool will give you that, okay, if you invest around, say, 4,500 rupees per month.
The calculation is what is done by them. So you
They
don't
buy
need...
them. And that will assure more or less some months market may go up, some months market may go down. But assuming a 12% kind of CAGR or a reasonable CAGR, you will be able to achieve your goal. So like there are certain amount of money where you want to be reasonably sure that as long as the country is growing, as long as the India growth story is
Yes.
intact, I will be able to generate that kind of return to fulfill my goals. So technology or a new investor use this technology to fulfill those life-based goals, and ETFs can play a very big role there.
ETFs can surely play a very big role in the long term story and long term investing story as well. Uh, Devarsh, is there an easier way to explain our viewers as well in the sense of when I'm picking my portfolio, right? It's not only going to be ETFs, there are going to be other, whether you are stocks, whether you are overall assets as well. How does one analyze how much to put in an ETF or how much? Because AI at one point will help you with your goal, will one point help you with picking out also what to look at it and on an ETF point of view. How should one be deciding then the factors that go into play of how much to put in an ETF as well?
Let's take this question in a form of, say, you like eating out?
I love it. I love eating outside food.
Right. So there are various choices available, right? There are some fine dine fancy restaurants where you go for the first time and you order a dish. Now it is an expensive dish. You may like it, you may not like it, right?
Yeah.
So there are similarly in investment worlds, there are some fancy, high priced investments like niche mutual funds or AIFs or PMS. You want to have that experience and obviously you will pay for that. But there are times like us where we want to just go for a fixed meal or a thali where you are reasonably sure of the quality and it is very low cost. ETFs in your asset allocation is like that fixed meal thali where it is very low cost. You are reasonably sure of the quality of the returns which you get, and unlike a selection risk where you are when you are trying to pick an individual stock or individual company, that company turn out to be a great company or a
It
dud.
could be,
Yeah, a mutual fund can turn out to be a very outperforming fund or underperforming fund. ETFs is like the average return at a very low risk, very flexible in investing, highly liquid instrument, very transparent, where you are reasonably sure of the outcome few years down the line. Obviously, there will be market risk, there will be intermediate volatility, but eventually, I think if you stay invested in a well diversified long term ETF, I think it will fulfill your needs for average market returns.
average market returns is right, and sometimes the simple basic thali gives you the satisfaction as well and
Correct.
gives you a return also.
Correct.
The other side, sometimes you go fancy, you may see something good, may see something bad. There's a risk that you take, but this is lower risk, lower cost that comes in as well, and you know what your returns you're going to get after that as well. So you know what is the flavor that you're tasting for ETFs as well. But very well put there, Devash. It's easy for everybody to understand now. uh, when you talk about overall the moves that come in the market as well, right? Now, ETFs is something you said that I can go on a digital platform and also look at it like I'm buying a stock. Simple, right? It's at the price. Then is it a factor that becomes in play for a short term side as well? Right now, we're talking about long term. But is this more traded also like a short term?
Yes, since it is traded, it also the fluctuations are there intraday during the day. There are some market related news or a country related news, and sometimes markets go down 4, 5, 10% during the day. Now, if you want to invest on those times, many times happen that the stock or a market goes down drastically, and at the end of the day, it recovers. But in case of ETFs, during those periods where there is panic in the market, you can go out and invest in those ETF at those prices which is available. So short term tactical plays are also available. You can use these limit orders to benefit out of those fluctuation. Similarly, traders use leverage also. So now brokers do provide margin trading facilities on ETF like us. So where you can leverage your capital for short-term trading purposes. If you are reasonably sure about the short-term outcome of the ETF, you want to bet on a particular sector. Say, for example, say banking ETF, bank stocks have come down, and you think that there is a reasonable chance that I will get certain amount of return in next 2, 3, 6 months. Then traders use these kind of opportunities to invest in a sectoral ETFs, a pharma ETF or a banking ETF or an IT ETF, where they want to take a tactical approach towards tactical bet on a individual sector. ETF plays a very important role.
But I just am wondering if today more people do it for the short term, then doesn't the risk increase for my ETF as a person who's investing for long term? But because there is so much short-term activity happening, does that in any way cause a risk for a retail investor who's maybe holding it for the long term then?
So the short-term trading provides you liquidity. The underlying return will always mirror the index.
Index.
So if
Okay.
the underlying index or the commodity grows a certain amount of percentage over next 2, 3, 4 years, your ETF is going to provide you that return. The intraday volatility is to be for the short-term traders. It doesn't affect the long-term investors because ultimately the ETF which you are investing for long term will mirror the underlying index.
So that one does not have to worry about just because a short-term activity has gone up in ETFs. Has it gone up though?
Yes, it has gone up, and a lot of individual stocks or individual traders may lose money in trying to select a particular stock. But if you are trying to benefit out of the market volatility, and if you are betting that the markets will move up in a short term, ETFs can also play a role in trying to avoid the selection risk, where you are just betting on the overall market, not on an individual stock or a mutual fund.
Devarsh, you touched upon goal-based investing. You mentioned how, one could look at it on digital platforms also, or even through the help of AI today that you have availability. When you type down everything, you would get it. But how would you specifically tell someone, maybe who's looking at a retirement goal, okay, he's in their 30s, is starting off, right? To invest for the long term, you have a long period of time before your retirement. How should one be looking at ETFs in that portfolio? It's safe. It doesn't have risk. It's low cost as well. Then does it merit for a person who's retiring to put more money in ETFs versus others?
Right. So compared to the other instruments, it is relatively safe.
Yeah.
Obviously, it has certain market risk, but if, as you said, you are investing for very long term, 10, 15, 20 years, then you are reasonably sure that as long as the country is growing, as long as the top companies are growing, underlying index companies are growing, that investment will give you those kind of returns. Right. So, the beauty of investing in ETF is that you can actually put larger amount of money without worrying about the overall risk of
Risk
selection,
scenario.
right? Because why it has become so popular in US, why it is becoming so popular with regulators, and EPFO is also putting large amount of money, is that the beauty of index, where even one or two sectors may perform, one or two sectors may not perform or underperform, but eventually the index gives you that average return, and
Yeah.
that return is sufficient to beat the inflation, beat your long term goals. That's why ETFs are becoming very popular with the pension funds, with the regulators like EPFO and other large endowment funds abroad. And that's why the corpus under the ETFs are
ETFs.
growing so rapidly.
Devarsh, I just want to understand one thing, right? Right now, markets are so volatile, right? If someone buys as an investor, buys an ETF, whatever ETF it may be, they've chosen. And suddenly it sees a fall because of market volatility. Now, next couple of months, it's seeing a decline. Uh, like we buy stocks because it's an exchange traded fund. Is there a similar way that, how do you know when to average, when not to average, right? Because you would have an option of buying the same thing at a lesser price. Then does that merit as a story to play for the long term, or does that depend on your goal? How does one look at all of that?
So if it is a niche ETF, then you always want to see the near-term prospects, whether the case for investing in that sector is still valid for next
You
1
should
year.
study it.
Yeah, you
Yes.
study it. But if it is a diversified, broad-based fund like Nifty or Sensex, and if after you invest, if it sees volatility of 4-5%, and if it comes down, then as long as you don't need that money immediately, you can safely average and bring your average cost of owning that ETF down, so that whenever, after whatever is
The cycle, whenever it changes.
yeah, wherever is this bad patch is over, once the earnings catch up, eventually the ETF is likely to go
And
back
because
to
it's following the benchmark itself, right? Whether the Nifty or the Sensex you're saying. So you don't have to worry in the long term.
correct.
If you're still a long term investor, don't need the money, then it's okay to look at it. And again, add
And
it, some of it as well.
correct. So if it is if it comes down, and if you have reasonable
Yeah.
time period to invest, then it always makes sense to keep averaging at lower level and keep reducing your cost of capital, so that whenever the bad patch is over, whenever the market actually goes up, all whatever corpus you have collected, that return will come on that larger corpus, and it will give you more returns.
Absolutely. And Devarsh, is there one metric or something that I should, as an investor, maybe look when I'm picking an ETF? What is that one thing that you shouldn't miss out when you're buying an ETF?
So obviously the underlying theme, whether it is a niche ETF, whether it is a global ETF, it is a commodity ETF or a diversified index, it is the basic thing which we need to do. We need to check. Other than that, there are some basic parameters like tracking error, whether it is tracking the underlying index properly or not,
Okay.
how much liquidity is there, what is the kind of AUM which is following that index. Those basic things, if you check, then there is no, it is not very complicated. It
It's
is
an
very
easier
simple.
way versus mutual funds or other
Correct.
investment methods that you have or assets that you follow. So quite easy. Follow the benchmark. There's tracking error that you need to see as well.
Mm.
But apart from that, is easier to invest. If you had to give a word of caution, maybe for an investor who's starting to invest here, what would it be before buying the first ETF?
No, actually, the advice would be to look at ETFs. See, now young investors, we see that when they open an account through app or through digital medium, they start trading on derivative side, or they start
Yeah,
trading
immediately
in
everyone jumps to FNO
FNO
now.
now. But it is better to start goal-based investing using ETFs and set aside certain amount of your capital towards such ETFs, so that even if your adventures do not pay out, actually you have some savings which will help you fulfill your financial goals.
Just the last one from me. Now, given how fast we have seen global markets scale up as well from the ETF fund, Indian ETF markets are also picking up pace, like we understood through the whole conversation as well. Maybe next 5 years down the line, what is a conversation you think that we'll be having on Indian ETFs?
So, 5 years down the line, see, Indian ETFs are growing quite rapidly. From 2020, I think the CAGR is quite high, 50% kind of CAGR we are
Okay.
seeing in the corpus of ETFs, and it is growing, picking up well.
Mm.
I think 5 years down the line, we will have the conversation whether it makes sense to remain in active investments in country like India, or everybody should start only looking at ETFs or passive investment, which is the case in United States.
States.
But I think there is some time before that comes in. So there is room for all. But it's important that the investors, new investors, youngsters became aware of this concept and start allocating towards ETF.
Absolutely. Start allocating towards ETF. I think investors now are themselves becoming wiser as well. We have seen that increase, like you mentioned, the number, right? 50% CAGR since 2020 approximately is a good number. And hoping 5 years down the line, we again have this conversation. But Devarsh, thank you so much for joining us, explaining us the concept, easily explaining us. Me being a foodie, I understood it very easily. And thanks for taking us through those details of what we should watch out for, how we should be looking at ETFs as well. So thanks so much for that.
Thank you for having me. Pleasure is entirely mine.